Ahead of tomorrow's CPI, traders are eyeing this morning's producer prices for any hints that the disinflation trend will return or not. The answer is not. April producer prices rose 0.5% month-over-month versus plus 0.3% expected, with March's plus 0.2% month-over-month revised down to -% month-over-month. The downward revision did not stop the year-over-year read, rising to 0.2% from plus 2.1% in March. This is the highest YOY read since April 2023 and is the fourth hotter-than-expected headline PPI print. Producer prices have been aggressively downwardly revised for 4 of the last 7 months. Services costs soared, dominating April's PPI gains, with energy the second most important factor. Food prices actually declined on a month-over-month basis. On a year-over-year basis, headline PPI's rise was dominated by services, rising at their hottest since July 2023. For the first time since Feb 2023, none of the underlying factors were negative on a year-over-year basis. On a 6-month annualized rate, final demand core services PPI is rising at its highest since Q3 2021. After last month's farcical seasonally adjusted gasoline price, April saw the PPI gasoline index rise, with actual prices at the pump, but still has a long way to go. Core PPI was worse, rising 0.5% month-over-month, more than double the plus 0.2% MOEM expected, which pushed the core PPI year-over-year up to plus 2.4%. And finally, U.S. PPI final demand less foods, energy, and trade services rose by 0.4% month-over-month and 3.1% year-over-year, the highest in 12 months. Worse still, the pipeline for primary PPI is not good, as intermediate demand is starting to accelerate. Here are Wall Street's reactions to PPI. Chris Larkin at E-Trade from Morgan Stanley. Sticky inflation looked downright stuck this morning after a much hotter-than-expected inflation reading. But with last month's numbers revised lower, this report may not have been as much of an upside shock as it first appeared to be. Right or wrong, the CPI tends to have a bigger short-term impact on the markets, so the picture could look much different 24 hours from now. But if the CPI also comes in above expectations, the interest rate picture may be thrown into doubt. Bespoke Investment Group. The results of April's PPI showed a hotter-than-expected reading. That's the bad news. On a YY basis, though, the readings were much closer to expectations, as the market's report was revised down to negative 0.1% on both a headline and core basis. Chris Zaccarelli at Independent Advisor Alliance. This week is important for markets because they are worried about inflation, and this morning's producer price index hasn't done anything to assuage those fears. The most important data release is tomorrow's CPI print because the Fed's dual mandate is based on CPI and unemployment, with the former being what the Fed is solely focused on right now. We believe that the stock market will move higher throughout the year on strong corporate profits and consumer spending. But volatility is likely to spike in the meantime because the inflation data is going to keep the Fed on edge. So no, the Fed does not have inflation under control. However, there is some hope for tomorrow's CPI, as many of the drivers for the consumer prices that are echoed in the producer prices are not accelerating, with airfares down sharply, auto insurance flat, and general consumer goods markups down.